The markets are open, and at the moment it does look to be fairly mixed across the board, but today we want to draw your attention to LVMH. Now they are a luxury goods conglomerate with massive amount of brands under their umbrella, and just as a reminder, or for those that don't know, everything that is owned within LVMH, we're talking fashion and leather goods, massive names here, I'm sure you've heard of a lot of them. We have Christian Dior, Louis Vuitton, some very large names in that space. Wines and spirits, again, very popular, large names, very well known. And then we have the perfume and cosmetics, some selective retailing, as well as we can see watches and jewelries and some other ventures. Now, in terms of the company itself, looks like today is a fairly good day for shareholders, up nearly 4%. But year to date, this company is down nearly 18%. Over the last 12 months, nothing too great either, down around 10%. And over the last 10 years, it is fairly positive in all honesty, 290% up. That is outperformed the S&P, as we will come to show you, and that doesn't include dividends reinvested, although what we are noticing is in fact it's been around a year ago that this company was trading at all-time highs of $1,000 and currently sits at the lower end of the 52-week range. Now we do get a buy rating from Seeking Alpha, and they P on a trailing 12-month basis of 22 is lower than their 5-year average, and the S&P for context right now sits at around 25. Now the forward yield needs to be updated. This is actually around 2.1%, and we're going to do a deep dive, and the first place we think is best to start is that the CEO, Bernard Arnault, as we can see here, continues to buy a massive amount of shares in his own company. In fact, we're talking about, when we look at the transaction date, 16th of October, so just a few weeks ago, around 34,000 shares, and as we can see, in total, around 20 million euros. So very significant, as we can see, not the first time he has done that. We can also see he did buy some shares on the 23rd of September, and if you do take a look at the detail, he has been constantly buying in 2024, which is a bullish signal. Remember, insiders or management, in fact, we're talking about the CEO, they buy because they believe the share price will go up, and that is what we have identified in today's episode. Now we want to take a look at their latest investor presentation, Q3 2024, as we can see, released October the 15th, and it opens with two heavyweights in the tennis arena. Now, in terms of what they are saying at the very first slide, they actually say there has been some good resilience, but they do open up to the fact that this has been a challenging environment for the first 9 months of 2024, and we want to show you exactly how that translates into their numbers. So for the 9 months, when we take a look at their top line revenue, we can see transitioning from 9 months 23 to 9 months 24, there's been no organic growth. The structural impact as well as the currency effect have had a negative impact, and as we can see in totality, from the 9 months of 23 to the 9 months of 2024, their top line revenue is down around 2%. Not great. We'll show you how they've historically done as well. And very interesting to report that when we look at their revenue from a region by region impact, the US around 1 percentage point higher this 9 months of 24 than the previous in 2023. France looks to be the same, Europe marginally higher, but the real takeaway here is that Asia, whilst it looks like a very small drop of around 3 percentage points, is actually a very significant drop that the numbers will show you. So one thing with this company, they are having weakness in Asia, excluding Japan, and that isn't something that just relates to LVMH. We've seen this in Estee Lauder as well as other companies in this sector. Now, in terms of looking specifically, the first thing to note, as we've already mentioned, their top line hasn't pretty much moved in terms of organic revenue. The US, so when we're looking at the furthest column, this is highlighting the 9-month comparison in 2024. Up 1%. Japan looking very strong, up 36%, but this is effectively cancelled out by Asia, excluding Japan, down 12%, and we can see Europe up 3%. So in reality, you may look at Japan and say up 36%, we should see their top line revenue increase as such, but in fact their total sales from Asia is much more significant, and that is why the 12% drop has a larger bearing on this company's figures. Now, in terms of the actual individual revenue streams, what we can see, the wine and spirits continue to fall, down 8% from 9 months in 2023. Their fashion and leather goods look to be indifferent, around negative 1%. Perfume and cosmetics are up 5%, watches and jewelry down, and their selective retailing up 6%. So it does look very mixed. Some sectors have performed okay in comparison, but others, like we see wine and spirits as well as watches and jewelries, are down. Then we take a look at the actual numbers, and what we want to draw your attention to here is this final column, but you can also take a look at Q3 as well, just to understand the countries that are having the largest effect. We've already talked about Japan up 36% as well as Asia, but as we can see in totality, the net effect is 0% on their top line. Again, we've already covered, but if you want to see it in this tabular format, you can see net effect 0%. Their best performing has been the selective retailing alongside perfume and cosmetics, with wine and spirits continuing to trade down as it has done pretty much over the last few years. Now let's jump into some of the metrics, and the first thing we like to point out with this company, whilst their last full year dividend increase has been around 8%, they do historically over both the last 5 and the last 20 years increase these dividends at a double-digit rate. Now, in terms of their free cash flow payout, we personally want to see 60% or lower, just to give us faith management can continue with those double-digit increases, something we have seen over the last 10 years, 61 in 2023, 54% on a trailing 12-month basis, so we would be surprised if we don't, at a bare minimum, get those high single-digit increases. Then we move to the free cash flow per share, where we want to see consistent increases over the longer term, pretty much quadrupled from 2014 to 2023, but we do want to point out in 2021 it has peaked, came down the following 2 years, but is expected over the next 12 months to pick up just under $30 per share. Then we get to sales growth. Now, we already pointed out the first 9 months are showing for 2024 0%. That is why on a trailing 12 month it is very low. But historically, they do increase their top line at a very attractive rate. We just want to point out the justification of COVID for the 17% drop in 2020. And from a numerical standpoint, they have in essence nearly tripled their top line, 30 to 86 billion in 2023. And we do anticipate a small drop to that in the 2024 annual report. Now, we'd love it when companies do share buybacks, essentially returning excess cash to investor pockets, but this isn't something they do consider as part of their own capital allocation, so something just to flag, over the last 10 years, they've only bought back around 4 million shares, which is very minute in comparison to the total outstanding. ROIC, we do like to see this 10% or more to give us faith management are able to effectively allocate their capital. They've done that very well on a consistent basis, 16% in 2014, 21% in 2023, so very attractive for investors to consider as this is a very important metric. We then move on to operating margin, where we do see efficiencies across the board, 19% in 2014, 26% in 2023, and the bare minimum we want to note here is 16%. So not just increasing, but also above the minimums. Free cash flow margin also looking very good, whilst it is a little bit inconsistent, 12% in 23, 14% on a trailing 12-month basis, above that 5% minimum target. We then move on to the final metric here, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Remember, this correlates to dividend safety, balance sheet strength, and we want a maximum of 3, 2.9 in 2014, been coming down since then to 1.67 in 2023. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. So it does look to be good. It is expected to increase a little bit over the next 12 months, but as we can see, well below the maximum. Therefore, balance sheet does look good. We'll come to that shortly as well, and the dividend also does look to be safe. Now, we also want to let you know we release a free weekly article every Monday with the latest. We run through 2 stocks we are buying in November. If you want to click on the pinned comment below to sign up and read straight away, we also talk about severely undervalued stocks every week, as well as what's gone on in the market over the last few days. And you will also be able to grab 40 undervalued stocks for the month of November. We run through a lot of information for each one, as well as the upside that Wall Street themselves see over the next 12-month period. On top of that, you can grab a copy of 22 undervalued dividend stocks that Wall Street themselves believe have the most upside out of the whole S&P 500 over the next year. So click below, sign up, and you can read straight away. So we've already covered their top line revenue. As we said, it has nearly tripled from around 37 billion to 95 just over the last 10 years. But we want to flag here their bottom line net income. Does it follow a very similar pattern? And the answer is yes, whilst a little bit inconsistent over the longer term, moving in the right direction and similar to their top line, nearly tripling 6.8 billion to 16.8. So top line and bottom line do look very good. Ideally though, if we had to have one thing, we would just like a bit more consistency. And then we get to their balance sheet, total cash versus total debt. Cash has been very inconsistent, although has increased 5.3 billion in 2014, 12 billion in the latest quarter. But remember, in isolation, one number will never tell you anything in this part of the analysis, which is why we compare it numerically and directionally to their total debt, which unfortunately has been increasing over longer term quite substantially, in fact quadrupled from 11 billion in 2014 to 44 billion in the latest quarter. So something we do need to keep an eye on, and as we saw, the net debt to EBITDA metric is lower than the 3, a little increase expected over the next year, but so far no issues to flag. Then in terms of the valuation, whilst we don't have a grading because it isn't a US stock, it is a European, what we do in fact notice in terms of the P, as we've already mentioned, it is trading at a marginal increase to the sector median. In fact, if you are buying this company right now, you are paying around 11.4% premium. Is it worth it? That is something to consider and something we will look in our analysis when we do run through our margin of safety. But depending on which valuation metric you use, you are paying for a premium for LVMH. Then we get to the growth grade where we see the revenue growth year on year around 1%. Now the sector median also very low at 1.7%, so it does look to be an industry-wide issue. Revenue moving forwards at 3.2, pretty much in line with the sector median. Again, not much growth anticipated from the overall market, so that is something to consider with this company due to the issues that we have seen pretty much in Asia excluding Japan. It is affecting their overall top line. Then move on to the profitability where their gross margin 69%, a lot better than the sector of 38%. Their bottom line as well, 16.3, much better than the sector of 4.41. And the one thing that really stands out from here is their cash from operations over the last 12 months, 20.3 billion, significantly better than the 284 million of the overall sector. So lots to consider with this company, and we will get to the valuations shortly, but we just want to see how does it compare against others in the industry. We have Hermes as well as some very well-known big companies. Is there an issue with the industry or is it isolated to LVMH? And this is total return. If you include reinvesting those dividends, you would be down over the last year around 8%. It is in the middle performing, but what we notice, some companies in the industry have performed fairly well. Others, as we see, Lululemon and Kering also performing fairly poorly, in fact worse than LVMH. When we extend this to the last 5 years, we can see LVMH looking better around 62%, but it does look like some have performed very well and some have performed in fact a lot worse. So as the industry goes, some are very good performers, some are very poor, and we have some that sit in the middle. However, when we look over the last 10 years, LVMH is up a very respectable 363%, which is in the middle performing. Again, pretty much what we just said. Some like Hermes performing in fact phenomenally well, but then we have companies like Kering who have performed fairly poor. So as always, remember whether or not you believe 363% is very strong over the last 10 years, this doesn't indicate anything about the future, just something we like to add as one level of our analysis. Another thing we like to consider is the performance of the S&P, which has outperformed over the last year. When we look over the last 5 years, it has also outperformed, but if you do zoom out and look over the last 10 years, LVMH has actually outperformed considerably. Now, lots of things to consider, but as always, more importantly, let's get into the valuation model. And if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $892, we got this by these 3 models. So this is the average, which we can show you very quickly. We have the multiples valuation, companies in a similar sector and size that we just analyzed, their average P multiplied by the EPS of LVMH to give us our first intrinsic value showing undervaluation. Now remember, we're not looking at any of these models in isolation. We then have the dividend discount with the average growth over the last few years. Bear in mind they do pay in euros, so there will be some FX currency conversion. We have average growth looking very good. As we saw, it does tend to be very high double digits. We've gone from 6.5% moving forwards, giving us another undervaluation signal. Then finally, we have the DCF model with the free cash flow year on year. Average growth 25%. We've tried to be a lot more conservative at 6%, which is lower than the average but in line with the previous year. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, a third and final undervaluation signal, giving us the average of $892 in today's episode. As always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for LVMH or any others. Then we move on to MOS at 10%, which we execute on if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, then a buy at $803 in today's episode. Then we keep going till it's near the current trading price. And what we can in fact see is if you are buying this company right now around 669, 670, where it sits today, you are getting a 25% MOS. Now, Wall Street have lowered their forecast. We can see our intrinsic value of 892. They have a price of 795 over the next year. They see upside of 19%. Now, remember, this company yields around 2% in terms of the dividend, but give us your thoughts whether or not you believe this is a buy, hold, or sell, especially with the issues that we have seen to their top line and Asia excluding Japan. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.